Good morning, hunters. Welcome to the Daily Hunt for Multi-Baggers on this Friday, May 1st, 2026. We've just crunched all the social media data from yesterday, April 30th, and let me tell you, it was a busy day. We saw a significant number of discussions flagging numerous diverse stocks.
That's right, Ethan. The sentiment out there is quite mixed. We found strong optimism for some established tech players, but also some serious caution and, frankly, some eyebrow-raising enthusiasm around highly speculative plays. It's a real roller coaster, and we're here to break it down.
Let's dive right into our first pick, Sandisk, SNDK. Users are buzzing, pointing to its incredible 20x in 8 months growth and a recent swing to adjusted earnings, saying it's proving doubters wrong.
Well, Ethan, while that past performance sounds exciting, the KPIs tell a more cautious story. Its price-to-earnings ratio is a sky-high 37.45, and the debt-to-equity is 7.96, indicating substantial financial leverage. Historically, the net profit margin has been negative, and while Q3 showed adjusted earnings, it doesn't erase those deeper profitability concerns. It was rated stay away recently, and I'd classify it as stay away again for now due to the underlying risks and stretched valuation.
Fair enough. Next, Apple, AAPL. With earnings just yesterday, users were torn between moon or doom. But fundamentally, Apple has huge revenue, immense cash flow, and a dominant ecosystem, plus growing AI momentum.
Absolutely, Ethan. Apple's return on equity at 152% and a net profit margin of 27% are phenomenal. But the stock is near its 52-week high, and the PE is 34.35. The market has very high expectations, and even a slight miss on guidance from yesterday's earnings could trigger a significant pullback. It's too volatile for immediate speculative interest. My verdict for now is stay away.
All right, let's move to Meta. There's strong sentiment around buying the dip here. Many see its core ad business as a money printer and believes its heavy AI investments will pay off big, especially given the positive insider buying.
I see the conviction, Ethan. A 23.8% revenue growth and a strong 30% net profit margin are undeniable. The PE of 22.28 is also quite reasonable for its growth. While the market reacted to increased capital expenditure, the fundamental business is very healthy. After being rated stay away yesterday, I think the underlying strength for long-term potential outweighs the short-term capex concerns here. My verdict is buy.
Good call. Now, NextNRG, NXXT. There's a lot of bullish excitement that elevated oil prices could skyrocket its revenue by 38 to 57%, and users are even talking about it becoming an energy resilience play.
Ethan, the narrative is definitely compelling, but the numbers are alarming. Its net profit margin is a deeply negative 1.0477, and the stock has plummeted from $3.50 to just 37 cents. It's consistently losing money, and its liabilities exceed its assets. Any revenue increase won't matter if it can't turn a profit. It's been stay away or speculative gamble previously, and my verdict remains stay away.
Let's look at Western Digital, WDC. Some investors are making big bets, seeing recent price drops as a punishment and a chance for recovery, despite previous losses.
Ethan, this punishment comes with a PE of 41.15 and a P/B of 20.78. Those are extremely rich valuations, not a discount. While revenue growth is 25%, the debt to equity is a staggering 65.44, indicating high risk. What's more, insiders have been net sellers, reducing holdings by 8% recently. This was a buy back in February, but those red flags are too significant now. My verdict is stay away.
How about Caterpillar, CAT? Q1 earnings crushed estimates with higher volume and pricing. It's powering Dow Jones, and there's strong insider buying. This feels like a solid foundation for growth.
I agree. Caterpillar shows robust 18% revenue growth and an exceptionally high 43.5% return on equity. Despite a PE of 44.24, the strong Q1 results and significant insider purchases, up nearly 14%, signal strong confidence and potential for it to grow into its valuation. Previously rated stay away yesterday, it's a clear improvement. My verdict is buy.
Amazing. Now, Nvidia, NVDA, still riding the AI wave. Users are praising its crazy margins and predicting it to be the next $5 trillion company. The innovation and demand are simply off the charts.
Ethan, Nvidia's metrics are truly exceptional. A 73.2% revenue growth, a 55.6% net profit margin, and a 101% return on equity. While the PE of 40.65 is high, the PEG ratio of 0.76 suggests it's still undervalued relative to its growth rate. Plus, insiders have been net buyers, adding 5.75% more shares. The numbers overwhelmingly support the bullish sentiment. It had a stay away just yesterday, but the underlying performance is too strong to ignore. My verdict is buy.
Last but not least, Nokia, NOK. One user made a huge $650,000 bet, believing it's past its lost decade and entering a growth phase with 6G and AI RAN leadership. Even Jim Cramer has turned bullish.
The community sentiment is incredibly bullish, and the stock is at its 52-week high, having soared from $4 to almost $13. The PEG ratio of 0.76 supports the idea of potential undervaluation relative to its expected growth. However, the PE is a massive 80.69, and its debt to equity is an extremely high 15.63. Historically, revenue growth has been modest. This was rated stay away yesterday. While the future narrative is compelling, the current financials warrant caution. My verdict, acknowledging the strong community optimism and future potential, is buy with an understanding of the inherent risks.
All right, let's quickly recap and present our final list for today's deeper analysis.
Here are the stocks that stood out from yesterday's data. Investigate as buy, Meta Platforms Inc., MITA, Caterpillar Inc., CATR, Nvidia Corporation, NVDA, Nokia Corporation, NOK. Investigate as cautious buy, Apple Inc., AAPL. Investigate a speculative gamble, NextNRG Inc., NXXT.
And that wraps up another exciting episode of the Daily Hunt for Multibaggers.
A quick reminder, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred.
The market is a wild place, and knowledge is your best asset. Thanks for joining us, and we'll catch you next time for more insights on your hunt for those multibaggers.